Will the Fed cut in September? What to watch at Jackson Hole Markets thought a September rate cut was almost a sure thing. Then, inflation ran hotter. Job growth cooled, and odds slipped. Still high, but not a lock. Soon, Jerome Powell speaks at Jackson Hole. Will he hint at a cut or hold the line? The target range for the federal funds rate set by the Federal Open Market Committee, FOMC, is currently 4.25% to 4.50%, a level it has maintained since December 2024. Listen for three things at Jackson Hole. Inflation language. Does he stress further progress needed, or risks are more balanced? Labor market tone. Rising unemployment, slower hiring, and longer job searches all argue for easing. Risk management. The Fed often moves when the cost of waiting exceeds the cost of acting. The Fed has a dual mandate: price stability and maximum employment. Inflation side. Recent PPI, CPI, PCE prints show inflation sticky in services and shelter, tough to tame. Jobs side. Hiring is down from 2022 peaks. Openings are fewer, wage growth is cooling, and unemployment has nudged up. If the labor data weakens faster than inflation cools, the Fed tilts dovish. If inflation looks sticky, it tilts hawkish. Fed funds futures had priced September as highly likely. After hotter inflation surprises, odds pulled back, still leaning to a cut, but with real uncertainty. The Fed will emphasize independence. Markets care less about optics and more about the path of inflation and growth. If Powell is dovish, it'll be because data, not politics, supports it. The scenarios. Dovish tilt, hints at September cut. Stocks. Growth, tech outperforms. Small caps bounce. Bonds, yields dip. Curve may steepen a bit. Dollar per gold. Dollar softens, gold firms. Neutral base case, data-dependent, balanced risks. Stocks, choppy, leadership narrow. Bonds, range-bound yields. Hawkish tilt, emphasizes sticky inflation. Stocks, broad pullback, rate-sensitives wobble. Bonds, 2-year yield up, long end mixed. Dollar, firms, risk assets uneasy. Housing impact. If a September cut looks less likely, mortgage rates stay higher for longer. That keeps affordability tight, inventory frozen, and transaction volumes subdued. Builders with rate buy-down incentives may hold up better than existing home sales. Before the decision, watch. Jobs, non-farm payrolls, unemployment rate, wage growth, inflation, core PCE, CPI details in shelter, and services ex-housing. Activity, ISM services, retail sales revisions. A soft jobs report, plus cooler core inflation, could seal a cut. Hot services inflation could push it out. Powell likely keeps a September cut on the table, but not promised. If he sounds hawkish, brace for volatility across stocks and rates. If he opens the door to a cut, risk assets should breathe easier.